Good morning. I'm Fred Ruffy with Trade Alert here at the CME Group for Traders Exclusive. It's been a pretty busy week in the options market, especially earlier this week. We saw 19 million contracts traded Monday, 18 million Tuesday. Volumes dropped off yesterday to about 14.5 million contracts across all the exchanges. This morning's a little bit slow. Today I'm going to talk about the largest blocks of options traded this week, so far this week, and the directional butterfly spread strategy. The largest block of options that we've seen traded this week was a 50,000 contract block of April 140 puts on the S&P 500 Trust, ticker symbol SPY, which is the so-called spiders. What an investor apparently did here was they sold 50,000 of the April 140 puts on SPY, with SPY trading around 152. They sold those for 37 cents per contract. They also bought 25,000 of the April 140 puts, for 67 cents. They sold 50,000 of the April 135 puts for 37 cents. So it's actually, the big block was the 50,000 of the April 135 puts. They also bought 25,000 of the April 130 puts for 22 cents. So basically what they did here is they bought 25,000 of the April 140 puts, sold 50,000 of the April 135 puts, and bought 25,000 of the April 130 puts. So this is an April 130, 135, 140 put butterfly spread, and they paid a net debit of 15 cents, and the shares, the underlying, the spiders, are at 152. So this is a very large spread where they basically bought the 140, 135 put spread for 30 cents and sold the 135, 130 put spread for 15 cents. You can also look at it as selling the 135s for the body of the butterfly spread and buying the 140s and 130s for the wings. It's probably a hedge, but it's a very, very low cost spread at only 15 cents, or on one contract it would be $15, with a potential payoff of $4.85, which is the difference between the strike prices of 140 and 135 minus the debit that you pay. So this spread would offer a huge payoff if the market made a substantial decline and SPY was trading at 135 through the April expiration. So this is probably a hedging strategy, sort of a disaster hedge against a portfolio of stocks, because the S&P 500 is a benchmark for the market, and the SPY holds the S&P 500 stocks. And basically, it's an example of going deep out of the money and paying a small debit for a big potential reward. And as you, in the case of a put butterfly spread, move up the strike prices, the debits increase and the risk reward ratio also decreases. So that's it for today. The big block of trades we've seen this week was 50,000 April 135 puts on the SPY. I'm Fred Ruffy for Traders Exclusive.